All right. Welcome back to another one of our monthly webinars with our friends from Qapita. So I'm excited to have Evelyn here with us because we're going to talk about 409A valuations, which on one hand is not what most founders signed up to think about when they started a company,
Mhm.
but it's a lot of what you think about.
Definitely.
And I think that it's the kind of thing that if everything comes out as expected, nobody puts a lot of thought into it. But
Mm.
but it has a lot of far-reaching effects. And so I want to sort of take a little time to talk about why it's important, how to handle it. Just to start off, could you introduce yourself and what you do at Capita and why you care about for
Sure. So, hey everyone, Evelyn here from Qapita. Essentially, what we do as Qapita as a whole is really taking a look at a lot of private companies' equity matters. So, we do a whole suite of services here. We have our platform, our 9A valuations, and the like. But what I specifically do here at Qapita is hit the valuations team, whereby we specifically take a look at, in the US context, we look a lot into your 409As, your ASC 718s, and beyond that as well. But yeah, why we care so much about 409A, especially in the context of Capita, is we started off our business in Singapore, whereby, you know, multinational teams are very common. We're pretty much a hub for all of the world to really work in. It started off with one of our clients, our early clients, giving us a question like, hey, I heard about this thing called a 409A that I need because I have some US employees. So, like, do you know anything about that? Is that something you can help me with? And when we took a look into it as well, we realized that, oh my, there's a lot of companies, not even just outside of the US, but even within the US as well, who really aren't too familiar with the fact that there is this compliance requirement called the 409A valuation reports. So as we started to foray a little bit more into this, we realized that, okay, especially for all these early stage startups, it's really not something that comes across when they first start their businesses. And then there's always a risk that, because they want to give out equity, they might get caught in a difficult position in the future, whereby they have to struggle a little bit with meeting compliance regulations, but also keeping their employees happy. So
so
why
so
we
let's
care so much here.
actually talk about like what this is, right?
Mm,
So if I start a company
mhm,
and it mostly comes into play in the early stage for options and equity grants, right? Because
mm,
I have to value the shares of my company, but I'm a little confused because I just raised some money from an investor and they
mhm,
gave me a valuation. So
mm.
why isn't that the value of my company? What's this other value that I have to do?
Yeah. So it's a little bit different there because when you do raise your money from an investor, right? So firstly, that's the value that the investor thinks that you would be worth, especially considering all the future potential that you have. And it's not that for a 409A, you don't consider that, but also that value that is being captured by the investors is very much captured in the way that they're investing, the terms that they're getting in the shares, the different type of shares that they're getting as well.
Right.
But
They're
when it
getting
comes
preferred
to
shares.
exactly, yeah, so they're getting preferred shares. So when it comes to doing a 409A, the real purpose here is because you have to be when you're giving out equity for your employees, they tend to be ordinary shares, common stock that underlie the ESOPs that you give instead. And there's a huge difference between the common stock and the preferred stock. Because ultimately that's why the investors wanted the preferred stock.
Right.
So
They get their money out
because of
first.
that. Exactly, yeah. So the preferred stock have a lot of preferential rights. They get their money first. They're entitled to, information rights, a lot of different things. They could even be entitled to dividends. A more of a long-term goal.
Right.
But the main case here is that since there's so much of a difference in the way the terms are structured for the different classes, you can't just take the preferred stock price as your new valuation for the common stock that you're giving out to your employees.
Gotcha. And your employees actually, even if you were to do that, they don't
Mhm.
necessarily really want that. They want
Exactly.
the common shares to be worth a little less. Why are they economically incentivized to have their shares worth less?
Yeah.
Because don't
So
they get paid more?
exactly. So The key thing here is the 409A sets a couple of things for the company, right? It's not just about an indication of the value that the employees might see that they're holding, but it also sets the exercise price that they have to be, constrained by. And what an exercse price really means for a lot of these employees is that if they get the ESOPs in the future, if they want to actually receive proper value, like in terms of actual cash or actual tangible value, they'll have to exercise these options and they'll have to pay exactly what that exercise price per ESOP is. And so naturally, since you are paying that money out, you don't really want it to be too high. That's why, because of that, the 409A is really about finding a right balance, whereby you don't want the value to be something too high so that the employees feel like it's a little bit risky for them. They feel like they're putting too much skin in the game.
Expensive.
Exactly, yeah, it's too expensive. But on the other hand as well, it could be a signaling that like, oh, why is the value so low? Does that mean my ESOPs are not worth much? So very much it's about finding this balance that the founders and the valuers have to strike and sending the right messages across to the different stakeholders.
And there's kind of a responsibility to get it right. It's not the kind of thing that you can just go to your employees and say, "Hey, how cheap do you want this to be?" Somewhere
Hmm.
along the lines, legally, you actually have to do some work to justify it.
Exactly. Yeah, definitely. And why that's so important as well is because there's legal repercussions to if you set it wrong, essentially. So why the valuation reports are required is because by this, section 409A in the Internal Revenue Code, you have to set your exercise price of the ESOPs that you give out to your employees minimally at the fair market value of the common stock underlying it. So if you do set it below, then, it comes with penalties in terms of fines for both the company and also the employee. So it's a very expensive payment that you have to do. So you can't just go to the employee and say like, all right, what's the price do you want? Then I'll give it to you, because it needs to be backed up by a proper exercise done, a proper valuation exercise done, so that you can justify what the exercise price is for the employees.
Okay, so that sounds important. I don't wanna get
Mm-hmm.
fined. I don't wanna get in
Mm,
trouble. So this is more than just a check the box thing. Now
mm-hmm.
I wanna think about, like, how founders actually think about this because
Mm,
there's no average or standard. I hear founders a lot saying, "We're a seed funded company. Shouldn't we be X percent of our preferred price?"
mm.
Why is that different from company to company? What are the factors that go in that could make that change?
Yeah. So I think there's this little golden number that everyone talks about. I think it's somewhere around the 60%, the 30 to 60% that people usually think of. And it's not, I mean, that number did come from, proper valuation reports that's been done. It's a proper trend that has been observed, but it's not really at a hard or fast rule, because where this discount actually stems from, I think we touched a little bit earlier, it comes from the difference in rights that the different share classes have. So with the investors having the preferred stock versus the employees getting the common stock, that difference in rights is what actually results in that difference in the value, so that discount. So why the discount can differ across multiple companies in different situations here, it really just stems down to what the cap table of your company looks like. So if you have a lot of different kinds of preferred shares with different rights. So maybe you have your Series A shares and your seed shares and some angel shares as well, of which, the Series A is better than the seed, and then the seed's better than the angel, and the angel's better than the common. In this case, because there are more layers in between the best preferred stock and the common stock, the price of the common stock naturally tends to get pressed down even lower. So the difference between the Series A stock and the common stock's price tends to be a lot larger than if it were just, a seed and common stock here. So that is where the difference stems from. But, this is really just one of the largest factors. There's also a couple of other smaller factors that could come into play as well.
Gotcha. And how does this get impacted when, for example, I have a down round? Or even are there situations where I could raise capital, but the A price gets lower even though I've raised more capital, maybe even at a higher price? Do they necessarily track?
It's possible for this to happen. We would say generally it's pretty rare. It usually only happens if, in, I would say the two most common scenarios would be one whereby if you do raise more capital, but the price difference isn't really that large from the previous round, such that your effective equity value really isn't going up, then that could cause the common stock price to effectively look lower than the previous one. Another scenario this could happen is if, markets are just really terrible and you just kind of raise at a very bad time, then naturally, even if your funding round looks pretty all right, pretty decent, it is still affected by market movements. And that could cause the price of the common stock to be lower as well. So mix of factors, these are the two most common reasons. But ultimately, I would say it's not something to really panic too much about. It is just really like the markets go up, markets go down, things can happen. And with early stage companies, things are always very volatile. So it's not something that sticks out as a huge red flag to people in the industry.
And do I do this for an evaluation only when I fundraise, or do I have requirements to do it more often than that? And how often should I be doing it?
So generally, it's good practice to do it on an annual basis, but that timeline can also be reset if, let's say, you have a huge event or like a specific, we usually call this like a specific price setting event. So that usually means that if you raise funds in the middle of the year, then, that resets your price and you got to get a new 409A done. It could also come in the form of, let's say, if, you guys did a huge new acquisition, you merged with another company, that also changes the composition of your company very significantly. And that does require a new price discovery in the form of a valuation exercise. But if
What
all
about
goes
things
well and
what about things like milestones in the company? Like I've just started unlocking revenue and I never made revenue before, and now I'm
Mhm.
starting to make money, or a product launch or anything along those lines.
Hmm. So for those particular factors, we consider them more of like business development. And for these, we usually like to see a little bit of a history in terms of some traction that was gained, some
Gotcha.
months that we can really anchor on first before we consider that in. But generally, they would fall within the annual refresh of the 409A. They'll be captured within there. Within that every annual refresh, you can see the valuation adjusting with the new context of the business.
Gotcha. So, okay, you've convinced me that I have to do this and
Mhm.
get this right. So now I'm worried about a couple of things.
Mm,
I know that my 409A valuations are probably going to be in my data room for a next round valuation.
mhm,
Is there anything that's going to be in there that I should be concerned about how they might look to a next round investor? If I'm getting this, like when I pitch for fundraising, I'm trying to pitch the rosiest picture, the best picture of my
mhm.
company. And you're out here writing these very objective reports that, indicate all of the reasons why my common shares might not be worth a lot. Is there anything I should be
Mhm.
worried about that somebody's going to look at?
I think there's a couple of factors that might impact the way investors take a look at it. So I think the picture to set here is that because the 409A is compliance requirement here, it's a very commonly understood thing in the industry that the lens in which valuations are done for a 409A report differs very much from the lens in which investors look at a company for fundraising. Because when it comes to that particular lens of a fundraising, they're looking at the potential, the future. Whereas for a 409A, we're really looking at the objective facts of the company and in the immediate long term. So that lens itself already, it helps to sort of reframe why certain text, certain factors that we consider and also the value that ends up being the output can differ from what an investor thinks. So on top of that, I would say key things to note though is that especially for early stage startups, when they do get their 409A, there's a lot of tendency to try to see if we can get a conservative, favorable value for the employees. And because of that, you tend to try to show the realistic picture of yourself, but it might not really be something that you also want to be showing to your investors. So that gap it will be noticeable. It's understood by the investors, but I think it's just something to take note that whatever you put out there in your 409A will be seen by your future investors. So you'll also have to find a balance as to what is the kind of picture you really want to strike externally as well.
Gotcha. So now I'm going out and I'm looking at firms.
Mhm.
And, I'm a product person, I'm a tech person. It's hard for me to figure out the difference of why I should go with one firm versus another. How do you think about the way that Capita does 409A valuations and their services that is either different, or what should I be asking as a founder to understand, like, who's gonna be right for me?
Yeah. So I think on this point here, like there's a lot of different players in the market. So when it comes to a 409A valuation, I feel the most important thing is thinking about the credibility of the team who does the work for you. So with the advent of AI and automation, not that these are bad things, but the way each company utilizes these tools is also something to take note of, in that ultimately you want your report to be written and overseen by someone who is a human, who can exercise that professional judgment and not just, be an output of a model. So I think that's one thing that I would say in the recent world, in the recent times, it's something to take note of. But prior to this, it's really about looking at the qualifications of the team, the experience as well. Because when things are good, everything is rosy and fine. Your 409A just sits in your data rooms and somewhere in the folders. But if things ever do go bad, the 409A valuer that you pick has to be someone that you have confidence that could stand up in court to defend the report that they wrote and to showcase that they did their best with whatever was reasonable. So that's a bar that you have to hold your valuers to. And I think that's an important thing to think about when you actually look at the different players in the market and choose who you want to be your valuer.
I mean, you say stand up in court. You literally mean that, because when
Yeah,
this when this comes into play, this is shareholder lawsuits or employee compensation lawsuits and all of this sort of stuff. Like, that's the downside of this. This is not something that people
exactly.
think about a lot, but when this becomes an issue, it goes off the rails.
Exactly, yeah. And not that it is, extremely common. It's not like the IRS has constantly just scrutinizing every single 409A that's being issued, but the risk is definitely always there. So no matter what, you do want to select someone who could at least produce a report that they can walk you through. And it sounds extremely reasonable. Every input that they select has to have come from a sound judgment. And so when you choose a valuer, you just want to make sure that it's someone who knows what they're doing and can showcase that they know what they're doing.
Okay, cool. So I get my 401A valuation back, and let's talk about communicating this to my team and employees. So the valuation comes back, it's lower than the last round. I've already given out some equity to my employees. How do you suggest founders handle the valuation conversations with employees? And are there ways to mitigate downward movement in 409 valuations?
So I think it's a very tricky conversation to have for sure, especially if, let's say, in the previous 409A, perhaps you guys got to something like $1, and in the new one, you guys actually ended up getting to like 80 cents. So that's going to be a tough pill for the employees to swallow, because not only do they feel that, no, my previous ESOPs were priced higher, so now I'm making a little bit of a loss already, but the value that they see of their ESOPs has also dropped. So ultimately, this is a very difficult situation for everyone involved. It's not a pretty scene to be in. But I feel like at this moment, what the founders can do to the best of their abilities is to understand really, why did the value go down? Is it because of a company fundamentals? Is it because of maybe some unfortunate events? Or is it really just the market is terrible and times are bad? So depending on really what the reason underlying this drop in value is, the messaging to the employees can be softened, it can be managed as well. Because if it really is something as a result of uncontrollable factors, and I think this is something very real, given that the markets haven't been the best in the recent couple of months. So it is a reality that ultimately, if markets are bad, every other company is also suffering, then the messaging to the employees here has to be that it's a tough time. We just gotta, push through it. And I can promise you that we'll do our best to ensure that the company goes further up ahead. And in the long run, all this won't matter anymore because the company's value will be higher. It will be way better than your exercise price.
Yeah, I mean, ideally, you're not selling at these 409A valuations, right? And this
Exactly. Yeah.
only comes to play if the valuation is high enough for the preferred shares to convert and everybody to wind up with regular shares of the company,
Hmm.
either through an acquisition, and in which case you're generally always at a discount to the preferred anyway. So you should wind up okay as long as you clear the.
Exactly, yeah. And I think that's a very good point you mentioned, Charlie, because ultimately, let's say if all goes well and the company goes into an IPO, which is really the end goal that a lot of companies want as well, or even if let's say this were, a huge M&A sale that the company gets acquired, right? In these cases here, because they're considered good exits, the price at which the preferred shares and the common stock shareholders all get paid out at, generally it would be the same because they should all be higher than whatever they invested or whatever the strike price is anyway. So a 409A here takes into account a lot of the differences in the rights, and therefore that's where the discounts arise from. We look a lot into what's the present reality of the company, but when an exit happens, that if it's a good exit, everyone gets the same value, everyone gets the same share price, and that tends to be a lot higher than whatever exercise price the employees got.
Gotcha. So first of all, I appreciate your time. I know it's late or early there. It's late there.
A little late, a little late. It's 10 p.m. now.
So, but it is a testament to your team that, when we've been doing these webinars, I know you have people sort of across the globe. And so, and it actually does often fit that founders are here in the US are pulling all sorts of hours. And so sometimes it's great to have a team that
Mm,
is available when you're actually doing the, nighttime,
exactly.
especially for me, the post kid bedtime shift
Ah, yes,
is
definitely.
is very helpful. Well, this really clears things up, and really appreciate your time, and this was super helpful.
You know, thanks to Charlie. I think this was a great chat and happy to help for sure.
Thank you. All right, have
All
a
right.
good day.
Thank you. You too.